Thank you, Carrie. Good afternoon, everyone, and welcome. I guess good morning for those of you joining from the West Coast. Welcome to another session of Future of Engineering Roundtable, and we're excited to share with you Q1 sentiment survey today. I do want to take just a moment to thank all of our supporters who make this research possible. I know many of you are on the call today, and so just wanted to give a big shout out and say thank you. Without your support, this would not be possible, and it is sincerely appreciated. We're going to go ahead and get started because we do have a lot to cover today. And we have with us Joe Bates, who is our senior research consultant at the Institute. He is the one responsible for creating and maintaining our sentiment study. Thank you to all of you who have been completing them each quarter. Obviously, without your completion, we wouldn't have anything to report. So we appreciate your participation, and please encourage your colleagues to participate in the coming quarters as well. So with that, Joe, I'm going to turn it over to you to get us started, and let's dive in.
All right, great. Thanks, Daphne, and good to see everybody again here. This is our Q1 edition of the State of the Business Economy, State of the Engineering Economy right now. We're going to talk about the engineering and design services industry and just review a few slides that we created newly last year, the end of last year. And then we're going to get into how the economy is doing now, how is the AE industry economy doing, and then what's most important, what does the future hold? So in our first section, we updated our forecast in the fall of this last year. And so I'm going to show you a few numbers throughout today's presentation from that document. And the first one is just sort of a review. Now, I know 2021 seems like a long time ago, but obviously we've just finished 2022 and we don't have all the data that we would need available. It takes time for that data to come in. But what we see here is that we did have a pretty good hit to the economy. This is the engineering and design services output, by the way. It fell by 6.6% in 2020, but we rebounded very nicely in 2021. And we surpassed the 2019 numbers, so we hit a new record in 2021. One other thing, let me just back up for a second. I should say that when we initially projected the growth for 2021, we estimated it would come in at 8.1%. So we actually did much better in 2021 than we even predicted. This slide, I'm not going to go into too much detail. You can get these slides later. This information is also available to you in the report on the forecast, but it's just a reminder of how large the engineering and design services industry is. There's $373 billion in revenue. And when you add the multiplier of that to the GDP, it's even larger at $558 billion. There's a lot of direct and indirect benefits to the economy. And part of that is the number of jobs that are created, as well as the state and federal tax rolls. So our industry directly employs 1.5 million, and it supports an additional 3.2 million jobs throughout the economy. So it's a very big section of the economy. It's bigger than the oil and gas industry. So there's a lot to what we do. And also, just to let you know, in our report, we do have that by state. We have the taxes by state. We have employment by state. So lots of state level information if you're interested in diving into those details.
Yeah, and I think, Joe, at the end, we'll have a QR code on the last slide. So people can, if you want to have your phone ready, toward the end of the session, you'll be able to hit that QR code and get to all of these reports.
Absolutely. And also, don't forget, please use the Q&A or chat function if you have a question. Daphne's going to be monitoring that, and she'll ask those questions as she is able to do so. All right, so let's get into how the economy is doing right now. This is the whole U.S. economy. So U.S. GDP in the fourth quarter of last year remained positive and quite strong. You all may remember at the beginning of the year, we unexpectedly in Q1 had a negative GDP, but there were some more technical issues because of that or resulting in that. But we climbed out of that pretty quickly. And by the third and fourth quarter, we were humming along at more of that 3% growth rate. So this is really good news. It's actually tracking exactly as economists predicted it would track for the fourth quarter. And if you all remember from last quarter in September, when I talked about this, I said, watch the GDP numbers for the fourth quarter. If it comes in as expected, we're going to have a better year this year, I think, than perhaps was anticipated. And spoiler alert, I think that is possibly in the making. Not going to commit to it yet, but we've got some really positive indicators coming out, which we're going to go through. So another very positive indicator is the job growth. Now, this is a double-edged sword. We've created 500,000 jobs in January of 2023. And you can see that since the beginning of 2022, we've added almost 5 million jobs. If you add in January, it is 5 million jobs. So a lot of jobs have been created, which is amazing given how tight the labor markets but we're finding people. But you can see we were trending around that 3.6%, 3.5, 3.7 unemployment rate. But since October, we're really digging into the available workers that are still out there. This is as low of an employment rate as we've seen since the late 1960s. So this is an extraordinary picture that we're seeing here. And even though the economy is doing very well and we have a lot of job growth, the Federal Reserve is obviously still concerned. So we're going to talk about that in just a minute. And you might wonder, well, that unemployment number at the national level, how does that translate into the engineering and design services sector? Well, there's this one-line item in the report. The employment data report from the Bureau of Labor Statistics is professional and related occupations. That's where we fall. We don't make up all of that by any means, but that's where we fall. And you can see across this sector of the economy that's shown here, the unemployment rate is actually 2.2%. And it's been hovering anywhere between 1.8 and 2.2 for the last year. So it's even lower than the national unemployment rate. All right, now this is a slide that I keep showing because it's so extraordinarily important to explaining why we have the problems and the challenges in the hiring sector right now. There is a shortage of labor, and the reason is not because we don't have enough people in the United States. We have plenty of people, but it's the participation rate. The percentage of people who are able to work is very important. And you can see before the pandemic, it was a full percentage point higher than where it is now. It fell dramatically, obviously, due to the massive layoffs during the March-April period of 2020. But we did recover and it's been inching up. But in the last year or so, it's plateaued around that 62.3, 62.4%, a full percentage rate point lower than it was several years ago. The population has continued to grow. And so that's why we've had the job growth and the people that we're employing. But that 1% translates into 1.5 or 2 million people that are still sitting on the sidelines for one reason or another. And there's probably a variety of reasons. But one thing I mentioned last quarter is that there are an estimated 4 million people who are continuing to deal with long COVID and are unable to work as a result. That would more than make up for that 1% that we're seeing. And it would take us above where we were before the pandemic. So that's the real issue that we're seeing.
Hey, Joe, so we've got a question that came in. So you're talking about the labor shortage, right, which we're all familiar with. You're showing us the unemployment is at historic lows. How do these tie together with this labor force participation? Can you explain that just a little bit more for our viewers?
When we talk about unemployment, we're talking about the percentage of this percentage that you see right here. So 3.4% of the 62.4% are looking for work, but do not currently have a job. So if this participation rate went up, say 2 percentage points, the unemployment rate would actually go up. But that would be good news right now because it means we would have more workers available for those jobs. And that's what we need right now. So if we can get the participation rate up, that would help tremendously.
Thanks, Joe.
Sure. All right. Some other good news here is that, as I mentioned, the Federal Reserve has been raising interest rates very aggressively last year. We topped out at 9.1% inflation, year-over-year inflation in June of last year. We have come down almost 3 percentage points. That's pretty good. It takes time for inflation to come down, and we're seeing a really good improvement just in a 6-month period of time. That's why the Federal Reserve only raised interest rates by a 1/4 percentage point this last time. They didn't raise it a 1/2 percentage point or more, and the markets reacted very positively, and everyone was very happy to see that. But that was before the jobs report came out for January, where we added 500,000 jobs. So what does this mean? The Fed has said, this is Fed Governor Christopher Waller at the February 8th meeting, and he says the following: although economic activity slowed in 2022, I expect the Fed will need to keep a tight stance on monetary policy for some time to slow activity further in 2023. So he's saying the economy is still too hot, and it's because of the jobs report that came out. Some believe that inflation will come down quite quickly, and it's coming down quite quickly already. But he's saying that would be, and he says that would be a welcome outcome, but I'm not seeing signals of this quick of decline in the economic data for this year. And I'm prepared for a longer fight to get inflation down to our target level. So he was signaling at this time, hey, we're not done. We're probably going to have to continue these rate increases. And they're not signaling yet whether it's a 1/4 point, a 1/2 point. I think they're going to wait for some more jobs data from February and also the inflation number from February, and probably make a determination on that and all the other economic indicators that they're seeing. So we still have to be prepared for more tightening of monetary policy. Now, this inflation is also leading to wage inflation, and we've talked about this a bit. This is actually some data from the National Association of Business Executives, and this has been compiled by one of our colleagues, Diana, at ACEC. So she's keeping track of this data, pulling together lots of private market data, other data sources, and that information is being pumped out to you all as well on a regular basis. But what this is showing is a national survey of business economists and their predictions of what's going to happen. So essentially what we see here is regarding wages. And in January of this year, 63% of these individuals who were surveyed said they expect to see continued increases in wages at their firms. And so we're seeing this, and it's been pretty consistent in the 50s and 60s and even 70% last April in 2022. So there's probably no let up on the wage pressure that we're seeing right now. It's going to continue. And until we either cool the economy or we can get more people back in the workforce, these wage pressures are going to continue. And it's even hotter, so to speak, than was anticipated. If you read this top section, they ask, and this is not the data shown here, by the way. I thought initially it was, and that confused me. But in the writing, it says that the NRI is expected wage cost in the next 3 months. And when they surveyed people prior, the 3 months before October, it was at a 43. But when the reality came in October, it was at 63. So again, it's running hot, and it's still hot. So this is something we have to really watch. And in our own business sentiment survey, this is something we've been tracking for quite some time. We see that 75% of ACEC firm executives are concerned. They agree with the statement that they are concerned about inflation affecting their firm in the coming year. The same is true with the IIJA in terms of inflation eroding the impact. These numbers are tracking very evenly. So we'll probably be able to drop the IIJA question and just keep on track of the inflation number here. But we use this net rating. And for those of you who are not familiar with that, we take the percent of positives and subtract the percent of negatives. And that gives you the net rating. So you can have a total of a plus 100 if everyone is positive, and a total of a negative 100 if everyone's negative. So a positive number tells you that more people feel good than bad. A negative net rating would say more people feel bad than good. Well, how is this inflation number tracking over time? Good news. As the top line inflation numbers are coming down since June of last year, end of second quarter, we're seeing inflation concerns among ACEC firm executives also easing. It's still quite high, but it is starting to ease, and that's good news. So we are seeing this metric track very, very closely with the overall top line inflation numbers.
Joe, just for those who are new to our net rating, this is one of those that's kind of the flip of what we're normally looking for, right? We're typically looking for that positive to be higher and higher. In this case, it's good news that it's coming down. So it's a little bit counterintuitive to what we normally look at in our sentiment report.
Yeah, and that's absolutely correct, Daphne. Thanks for clarifying that. It's just because of the way we word the question, but in this case, a positive number is not good. So we're glad to see it coming down.
Right.
All right, well, another very interesting development over the last few months that was not expected. If you recall, I said last September that we were going to see continued increases in the 30-year mortgage rates. Something really odd happened, though, and the 30-year mortgage rate is pretty much tied to the 10-year Treasury note. And once we saw those inflation numbers start to come down, that 10-year Treasury note started to come down. So mortgage rates have actually fallen, and that's really good news in terms of the housing market. The Fed put a huge and a very quick stop on the housing market last year, and new housing starts fell by almost 12% or 13% last year. The NAHB just came out with that. They're the National Association of Home Builders. This year, they're expecting housing starts to fall another 25%. So, and these are the first double-digit decreases in over a decade. So the Fed did its job by slowing the housing market, but the job market is still on fire. And so the Fed's going to have to figure out what it can do to slow the overall economy, not just hit the housing market. The housing market took a hit. The economy is absorbing it and still doing very, very well. All right. So that's kind of the state of the U.S. economy right now. Lots of good news. And that is good news because things are holding up better than what people expected. But the concern is that inflation won't continue to fall. If we see the inflation numbers continue to fall, I think we're going to have a very good year. I think we may not hit a recession later this year. Now, I'm going out on a limb and I'm saying that right now, but let's watch for those February inflation numbers when we get to the beginning of March. All right. How's the AE industry doing right now? Well, not surprisingly, quite well. This is AE firm revenue by quarter, and we can see that the latest quarter we have available is Q3 2022. We will get fourth quarter 2022, but it's not going to come out, I think, until March. So we have to wait on that. But you can see here that ever since that bad quarter, second quarter of 2020 in the pandemic, we've been continuing to improve, and we're at all-time highs quarter over quarter at this point. And this is tracking quite nicely with our own forecast data. As when you look at that historic data from last year, what we predict for 2022 is tracking very nicely with these numbers. All right, so from our business sentiment survey, where are people feeling about the U.S. economy? Well, I told you last quarter, we were surprised to see this improvement from a negative number for current sentiment on the U.S. economy to 0. So that essentially says as many people were positive as were negative about the current state of the US economy. And now in this quarter, we're building on that. We've gotten even more positivity out there. So again, everyone's feeling the AE firm executives are feeling that there is progress being made in the US economy, and that's good news. But we haven't had to worry about that in our industry. Firms are very positive and continue to be positive about the sector as well as their own firm finances. And of course, there's no surprise to this. The IIJA is obviously helping this, but we came out of the pandemic strong, then the IIJA was passed, and now firms are starting to feel the benefit of it if they're working in those sectors. Now, we like to show some detail, and there's a lot more of these details in the full report, but I want to show it to you so you know it's there, and always point out something if you haven't heard me say this before. But this is the condition of the US economy by region and firm size. So that overall, we increased this far right column, we increased quarter over quarter by 12 points in the net rating. And look at the regions. Northeast, an improvement of 24 points. That's very, very good. Very strong improvement in the Northeast. And the South, Midwest, West, all of them saw improvements. Everyone's positive now as well. If you look at the second column from the right, that's our current net rating in each of these sections, these segments. Now, firm size. Look at the 1 to 25 FTE. This is huge. This is so important because so many of the firms in our industry are small firms, and they're the ones who feel the hurt first, and they feel the good and benefits last, typically on average. And so to see that number come up 25 points is great. Now, this one here, the 26 to 50, I can't really explain based on the data why that number fell from the previous quarter, but we do see a little bit of volatility at times quarter to quarter in these certain of these segments. So it could just be a little bit of that. But I'm not concerned because, again, smallest firms are doing well. Mid-sized firms, 51 to 200, also increased by 20 points. The large firms were always feeling a little bit better and normally do feel better, generally speaking, but they even increased. So good news across all firm sizes here. All right, now we're going to look at some of the sectors. And the top line here is that if you look at that far right column, 2/3 of all of these sectors within our industry saw increases in their net ratings. And they're all positive. If you look at the second from the right column, all of these numbers are still positive. But of concern, not surprisingly, especially given those numbers I just mentioned by the NAHB, we see that commercial real estate and land development have declined. So current sentiment in these sectors is falling, and it has been falling for the last year. If you look to the far left there, it's still positive, but it's definitely falling and taken a hit over the last year.
I think the other thing that I see here, Joe, is you've got these blue circles, right, which are the highest ones for Q1, and probably not surprising, they hit in areas of IIJA, the transportation areas, the water. But I did want to point out, you know, healthcare is in there as one of the top 5, and I don't know that, you know, we would necessarily have guessed that, and so it continues to be a strong focus area unrelated to the funding.
Yeah, absolutely. And, you know, that is something that we haven't really pointed out before, Daphne. So I think it's great to make mention of that. All right, so here's some other data from the US Census Bureau, not from our survey, but again, it just tracks nicely with what we're seeing in our sentiment data. We're seeing positive year-over-year increases from, this was 2022 versus 2021 in manufacturing, commercial, water supply, conservation, sewage and wastewater. Again, some of these here are really being affected by the IIJA. The good news here on the cool markets is these negative numbers have been shrinking, meaning getting less negative over the last year. So that's really good news. You know, these earlier last year, these numbers were up in the minus 20s, minus 30s. And so now we're seeing much more moderate declines, which is overall good news. All right, so this is a really interesting slide this quarter, because what we saw reported is that backlogs fell. This is a little counterintuitive given all the good news that we were just talking about. So we had seen right after the pandemic, backlogs had fallen very quickly to 6 months. Now, this is the mean across, excuse me, not mean, the median mean the middle point across all firms, all firm executives who reported data to us. So we'd seen it go early last year and from the prior year from 9 to 10 to 11 to 12, and suddenly it fell a bit. So one possibility that I think is definitely at play here is that we do have a labor shortage. Firms were taking more projects because that's what you do when you have projects coming in. And then all of a sudden you realize, wait, how are we going to actually fulfill all of these projects? So, and I'm going to show you some data that tells us why. What's happening with firms? Well, they're actually turning down work. This is going to result in backlogs declining. So that all ties together. There may be some other issues. I heard from an executive yesterday who said, Joe, something else that might be at play is we've put in a lot of bids, for new work for IIJA, and we're waiting to get approvals. We're waiting for the Department of Transportation to sign work orders. And so some of this may also be a little bit of a temporary lull. So it's not at all of concern to me. I think everything is going to be very strong this year. And this may be a one-time blip, or it may be that we're sort of leveling off to a more even pace here with the year ahead. All right, this slide, it's somewhat of a throwaway. We keep using it each time and it's the same, but the key point is that 9 out of 10 firms have open positions. So we know that firms are not able, they're hiring. That's what we know here. And the other slides and other data we have tell us that they're not just hiring, they're adding positions, and they still have a ton of open positions. And the mean, again, across all firms is 5. Now, this is a more instructive slide because it tells you the median for each region as well as firm size. And you can see something really interesting here, that the median for each of the firm sizes stayed the same, except for 201 to 500 FTE. It grew just a little bit. 25 open positions was the median. And at more than 500, the very large firms fell by 20, which is good. That is good news. But you would say, well, Joe, how come there was no change here? But you said that we're seeing more openings, and it's true. We're seeing that a lot of firms are having their averages are changing, and that's a little bit masked, I should say, by the medians.
Joe, the other thing we talked about yesterday when we were reviewing this was maybe something that might be more helpful that we'll try next quarter is asking about percentage of your workforce that is open, right, that you're hiring for, as opposed to just number of openings. So I think we might try and take a little bit different twist on that next quarter and see if we learned anything new.
Yeah, and the data that we are collecting suggests about 10% of their total firm staff size is in an open position. So that's pretty tough. If you're down by a man, 1 out of 10 people or a woman.
Or a woman.
Yeah, men or women. It can be hard to fulfill all the work that you might be wanting to get. So here's what I was talking about before, that half of firms are indicating that they're still turning down work. And this was so we asked this in the past 3 months. It's not just have you ever, but in the last 3 months, since we did this survey before, are you still turning down work? And we're seeing a very consistent half of firms are saying, yep, we are still turning down work because we just don't have enough people. Again, this feeds into the whole narrative about backlogs maybe coming down a little bit because they just don't have the people to take on new jobs.
Joe, how about how does this break down by firm size? Are you seeing any difference in, I know you've looked at that from firm size as well as the regions.
Yeah, so that's a good question, Daphne, because we like to show the firm size and the regions on a lot of these metrics. And I even have in the text here that, the firms in the Midwest are a little more likely to turn down work. Those in the South are a little less likely to turn down work. We did not see any difference by firm size. So whether you're a small, medium, or large firm, half of the firms are saying we've turned down work because we don't have enough workers.
No one's insulated from that.
No, not at all. So what kind of work are firms turning down? This is an important question. And we see that almost 8 out of 10 firms are saying that they're being more selective about the projects that we accept. That's good. That's not bad. That will help profitability for sure. And some firms are turning down less profitable work, a majority. So again, not bad for your individual firm, but you have between 20 and 25% over the last 6 months have said, we're turning down good, profitable projects. That's not what we want to see. That is a very strange phenomena. It's very odd to have that many firms saying that we're too busy, we don't have enough people, and we're turning down jobs that we could make good money on. So that is something that we're going to have to continue to watch here.
Hey, Joe, before we leave this section, we did get a question that I just want to tee up for you. So the question is, are these numbers kind of in general that you've been presenting skewed a little considering one-time ARPA funds? And just kind of for some clarity, the increases in our industry, kind of overall that you've been showing, and curious about if these are due to these grants or the economy as a whole. So in other words, are these short-term increases or something that we think is more sustainable?
Yeah, I would say this is very sustainable, just based on the fact if we go back a year and a half to when we started this process of sentiment measurements, we've seen these levels continue to be very strong in the industry. We're not, and we don't think that's temporary at all. Now, could it be that after 5 years, when IIJ funds run out or these one-time grants have been used up, could we start to see some moderation? Yes, and I'm going to show you the forecast. But I don't think that ARPA is muddling the waters here. If some numbers might be moving a little bit because of this, I don't think it's in a significant way.
Yeah, because I think if you look back, for those of you that aren't familiar, to the beginning, so a year and a half ago when we started 2 years ago, that those 80% or the plus 80 ratings for the industry and the firms have been consistent the entire time, right? There hasn't, a notch here or there, but nothing significant.
Yeah, exactly. But it's a good question. Very good question. All right, so keep those questions coming, and we'll continue now with what does the future hold? Well, we asked a new question this year. We didn't actually ask it last year, but the question was, what do you think going into 2023 are your biggest concerns? Well, not surprisingly, the top two are continued upward wage pressures on existing staff and continued upward wage pressures on new hires. Not surprising given what we've just talked about, and I think this is going to continue to be the biggest challenge throughout this year. It's possible that we could have some type of external shock to the economy, but we never know when that type of thing might happen. So given what we know right now, the economy is doing very well. The Fed is trying to manage a soft landing, so to speak, because everything's overheating. And, I think we're going to continue to see these wage pressures, though. But one of the things that surprised us, we threw in a whole bunch of things here into this question. And the third item on the list is workplace challenges due to hybrid work environment. This was pretty interesting. And last quarter, we asked about hybrid working and how often are you having your staff come into the office? And there's a lot of great data from Q4 on that. And I think we only asked it that one time. And so to see that this is a real challenge, I think we're going to have to revisit those questions and see, has anything changed since we asked those questions about how many days are you requiring people to be in the office? What is your remote work policy right now? I think we're going to monitor that because this is obviously a significant issue. There's a lot of other issues that are concerning to a minority of firm executives, such as cyber attacks or the impact of higher interest rates, but really those are dwarfed by those other two areas. Now, there's an interesting stat here, Daphne. Do you want to pull that out for me?
Well, I was just going to say, people might be looking at this and looking at that 16%, which is not insignificant, right, of other. And so when I saw that in the first review of the report, I said to Joe, what's in there? Like, we need to dig into that. And I think what you're going to share in a couple of minutes around inflation and some of those is tied directly back to this. So before we left this slide, I wanted to point that out so people didn't sort of wonder whatever happened to that 16%. It's coming. Stay tuned.
And for those of you who aren't survey researchers like myself, anytime you see that other get above 10%, probably means you missed something in your list. And that was by design in this case. So we have another question that's going to show you some other concerns, but these are ones that we thought we'd ask about. And it is important to note here that these concerns, the top three, they're the same across all segments, all firm sizes, all firm locations. So a little bit of other data from the National Association of Business Executives that Diana pulled out for us. This is one of the concerns coming out of that survey, which is too much monetary tightness, that you could only select one item here. You couldn't select more than one like you could in our question. And so obviously there's a big concern out there among executives, even in the broader economy, that the Fed will tighten too far. I don't share that concern right now. The economy is just so hot right now. I think they can continue to dial up the interest rates, and they need to do that. They need to normalize interest rates, because when we do have a recession in the future, they need to be able to cut interest rates. And we were at a place with zero interest rates that you couldn't cut if we had some problem with the economy. So now is as good a time as we've had to go ahead and ratchet up those interest rates. And now that they're seeing inflation coming down in a significant way, they're going to stay on top of it and hopefully not let it go the wrong direction again. All right, so we're talking about the future here, right? And what are the concerns? Well, just a reminder, we've got a lot of money coming in through the IIJA. We're entering into year 2, essentially, of this. And transportation has the bulk of the money: roads and bridges, airports, public transit, even electrical vehicle charging stations. I'm working with another group, and they actually are seeing a lot of demand for infrastructure being built out for electric vehicle charging stations. And we've probably heard about that in the news. So that's going to continue as well. So there's a lot of growth areas here as well, new areas of investment. And then you still have power and grid, which is essentially utilities. You have broadband, water, and these are sectors that we are looking at and tracking. All right, so before we get to the sector performance, let's kind of take that 50,000 foot view again and look at what we're seeing in our forecast. This is again coming from last October, and we're seeing that in 2022, we expected to see an 11% increase in revenues year over year. That's nominal output. And as I told you, we're on track to do that based on the data we have seen coming out. Now, that sets us up for a very strong 2023 at 6.1%. And we continue to see strong nominal output growth until it starts to moderate in 2025 and 2027. Now, the real issue here, and I was working with our economists on this, because at first we were just going to put these top line nominal output numbers in the forecast. And I said, we have to show what real growth is, because inflation is so hot right now. And you can see how inflation is really cutting into overall output. When you account for inflation, real output is only expected to increase 3%. I say only, but that's a really good number in 2022. And in this year, 2.3%. Again, we might see better than that, given some of the indicators we're looking at right now. And then it does moderate and it flattens out. So this is something in these years in 2025 to 2027, we're really going to have to watch, and we have to get inflation under control in order to keep our numbers moving in a positive direction. All right, well, what are the firm executives saying this quarter about their future sentiment? How are firm executives feeling about the year ahead? We see here that condition of firm finances is positive. The net rating, remember, is plus 33. Condition of the engineering and design services industry, positive at a plus 19. Condition of the U.S. economy, not as great, still in the negative territory. Now, I've mentioned this earlier, but I just want to mention it again. We almost always see with our sentiment numbers, largest firms are feeling more positive. Smaller firms tend to feel less positive, and that's why we really need to look at those firm size numbers as well. Well, how's it tracking? How are these numbers tracking? That negative 15 on the US economy, it's an improvement. It's going in the right direction. So in the third quarter of last year, the future sentiment was pretty negative at a negative 40, and it's starting to climb back up. So that means, again, that firm executives are feeling more positive about the year ahead of us than they were. So things are going in the right direction. The other part I want to point out here is that number on the engineering and design services industry went up 7 points. I think that's probably being boosted by the overall US economy number, because firm finances are pretty steady here at plus 30, plus 33 in that range. So I want to drill down into some numbers. Actually, we don't have the drill down on here, but just so you know, on that firm size, when you look at the design services industry, engineering design services, that's being reflected across all firm sizes, as well as those small firms, and particularly those small firms. So it's really important to keep that in mind. Okay, here is that other slide we were referring to that Daphne mentioned, reasons for economic sentiment 12 months from now. So among those who are feeling pessimistic about the economy or their firm finances or the industry, we ask them, why? Why are you feeling this way? These are the reasons. Recession concern is now number 1, and inflation and rising costs is number 2. Now, the good news here is that inflation and rising costs, the concern did come down by 7 percentage points, but it's still very, very high. So now recession concerns actually went up a bit. So that's number 1. Interest rates, number 3. Again, we see this from the NABE data. We're seeing it in our own data, and that percentage went up just a little bit as well.
So Joe, I think, these are some of those pieces that were then in that other bucket itemized by our respondents, right? The other thing that I think is interesting about this, I remember last quarter you talking about the supply chain issues and that you felt there was going to be easing in that. And it looks like, in fact, there was pretty significant 11 percentage points of easing in the supply chain issues. So that's good news.
Yeah, and thank you for remembering that, Daphne. You are correct that I was correct. So always happy to see that. I'm not always right, but it's good to see a result when I am right. But yeah, that's a pretty big drop there, 11 percentage points on supply chain issues. And we know this has been an issue as we came out of COVID and the pandemic, but it's definitely easing here, and that's very good news. Here's a slide I wanted to show you. I was thinking I had them reversed, but this is that breakdown on the condition of the engineering and design services industry. Remember, we're at a plus 19, it went up 7 points. So how does that reflected on firm size? Again, very, very well. Not as strong of the number itself, a plus 5 for the 1 to 25 firms. That's not as high as we'd like to see it, but it's an improvement of 10 points. That's really good. And this is future sentiment. And that's why this number is so important. When small firms are feeling more confident, they're more likely to go out and hire. The large firms are already feeling good. They've been feeling good. And so they're continuing their hiring. But it really is the small firms, small businesses, individuals who go out and start up their own firm. That's where job creation is usually really happening. So it's so good to see that here, that these numbers are all positive, and we want to continue to see those small firms feel more positive in the year ahead. Here's those sectors, and again, the future sentiment on sectors. We see almost all of them on that right column are improving quarter over quarter. And look at the top one, residential land development. So again, it's still negative. And the current sentiment, remember, it fell also. But future sentiment is improving. So that is good news. And healthcare facilities, one of the strongest places right now, also saw a really big bump in terms of future sentiment. All these numbers are a lot lower than current sector sentiment. And that indicates that hesitation that everyone's feeling about the broader economy and what might happen, but it's moving in the right direction. So that's what we want to see. And let's go back to that issue of backlog. So we know it fell. The mean backlog went from 12 months to 10 months over the last 3 to 4 months. But this is also, again, why I'm not concerned. Firms are still positive overall. The net rating is positive, and it's starting to inch up in terms of anticipated backlog 12 months from now. We did see a decline there, a bit of a hit from Q2 of last year to Q3. And that was, I think, because of all the concerns about inflation that were coming, and are we going to be able to get inflation under control? What's going to happen to our sector if the broader economy goes into recession? But I think those concerns are starting to ease here.
I don't know, too, I'm sure many of you saw Morrissey Gooddale's email that went out today, and they hit on the backlog issue, and seems to be kind of in line with what we're seeing as well. So I think that it's always good when you've got some reassurance from other groups that they're seeing the same thing.
Yeah, absolutely. Okay, and hiring growth. Well, like I said, there's a lot of open positions. About 1 out of 10 positions are open right now, and firms are trying to fill them. And we see that firms believe that they will actually see increases in hiring over the next 12 months. So that's increases on top of the current tight market that we're in right now. So we're at a plus 65 on that net rating. It's pretty high, and it doesn't seem to be coming down very quickly right now. So this is definitely, I think, the issue of the year at the moment. All right, just for fun, we threw in a couple additional new questions this quarter. And again, be sure to get your questions in. We will have a few minutes to answer any questions if you have them. But we always ask a couple new questions. We call them hot topics. And we had been hearing anecdotally last year from some firm executives that they felt that ESG was perhaps a fad that was dying out, that perhaps there was less interest among investors in these issues, or tracking this information. But what we're seeing from firm executives is that 34% of them actually say ESG is going to be more important this year than it was last year, and only 8% say it's going to be less important. So on balance, we're still seeing that this is a very important issue, a very important item for firms that are working on this. And not surprisingly, when you look at firm size, the largest firms are the most likely to say that this will increase in importance. In fact, they're twice as likely than smaller firms, but that makes sense. If you're a 25 or smaller FTE firm, these are not things that you can really deal with on a day-to-day basis. You don't have the large number of staff and the infrastructure within your company to focus on this as much as a large firm would. But what's
Certainly still important.
Certainly still important, absolutely. And you'll see that second bullet point regardless of firm size or firm location. No segment, no more than 11% in any segment said that it was going to be less important in the coming year. So there might be some firms that are putting less focus on this, but overall, this is going to maintain its importance, if not grow this year. All right, and the last interesting tidbit we have for you today is about COVID. We can't get away from it, and it'll be a while before we really can put it in our rearview mirror. But what's happening is now we're starting to see lots of results from research that's coming out about the impact COVID has had, not just on people's health. You see that a lot in the news. But I am actually working with some researchers at the University of Minnesota, not on this particular issue. I'm working with them on other issues, but they're working on these issues. They're education researchers. And what they're telling me is their data is showing that younger children are being more or were more impacted and are continuing to be more affected by the impact of COVID on the school shutdowns, on remote learning, etc. And students who are in transition. So if you are going from pre-K to kindergarten, if you are going from elementary to middle school, from middle to high school, from high school to college, those transition years that occurred during the pandemic seem to be more problematic than for others. So how does this translate into our world? Well, is there going to be an impact on STEM majors? Are there going to be fewer people who are interested in STEM majors in colleges because of the impact of COVID? And we don't know quite yet, but firm executives are saying, I am concerned about that. Over 3/4 of firm executives are saying, yeah, I'm worried about the impact that COVID might have on STEM majors. And I can tell you from my own personal experience, and this is just one case, but my own son, he had to take an extra year to get his footing back. He was one of those who was transitioning from high school to college. And in fact, he's now an aeronautics engineer major. So, but it took him an extra year to get there. So this is going to be something that we have to watch. We'll watch the research as it comes out. And this is something we may have to address on a much more national and international scale even.
Joe, just one comment before we leave this, and then a question that's come in as well. So I would just say to our listeners, as you are, kind of going through your day and week and have some of these hot topic issues that come to mind, please feel free to shoot us an email with those, because each quarter some of them are trending ones that we're keeping in, but we're always looking to know what's of interest to you, what's on your mind, what's that burning question that keeps you up at night. So please feel free to send those our way. The question, Joe, I'm not sure you're going to know the answer to this. It seems to me to be one that's more for probably our advocacy and policy team, but I'll shoot it to you and you can let us know if that in fact is the case. Any insight into whether Congress will roll back R&D amortization tax law?
Yeah, that's a really interesting question, and I have no clue. I would think that if we can get Steve Hall on this one, he might have some insights there. But yeah, that's definitely outside of my expertise and reach right now. But we'll see if we can get Steve Hall to answer that and get back to the questioner about that.
Yeah, I made a note of it. Thank you.
All right. Okay. If you've got any last minute questions, now's the time to throw them our way. I'm going to wrap this up here. So what's next? What are we looking at? Well, unemployment is still at record lows. Buying power is very strong right now. The consumer is spending, and the consumer spending data is showing that. Consumers are even adding to their debt load, which they can only do that for so long, but the consumer is healthy right now. Rising prices, yeah, they're eating into purchasing power, that's for sure. I'm trying to plan a vacation for my wife for her birthday, and airfares are absolutely higher than I've ever seen them before. Now, part of that's that I'm trying to plan it during college spring break, but I can't help when her birthday falls. Nonetheless, we're seeing that purchasing power is being eroded. But again, the consumer is very healthy, and so consumers are handling the inflation right now. Housing market, yeah, it's definitely faltering. Certain markets are falling. partly because they were already overheated and they just couldn't sustain the levels. Overall, we've seen a mixed bag of predictions of those firms that follow the housing market. I've seen anywhere from, oh, it's going to grow this year by 5% to it's going to fall by 20%. So it's all over the place right now. And I think everyone's still trying to figure out. I think the spring housing market will tell us a lot about what's going to happen this year, and it's just about to kick off. But we've seen overall national prices fell by about 2 or 3% in the last 12 months. Not a lot, but again, those mortgage rate numbers are coming down, so that's going to help with affordability just a little bit. And of course, recession watch. We got to watch out what's going to happen. Are we going to have a recession or not? I'm putting my money on maybe not. All the experts out there are saying if it happens, it'll be later in this year. But as I said, if you watch these numbers that are coming out and they're beating expectations, which they generally are, or meeting expectations, less and less and less of a chance we're going to have a recession. Or if we have some negative growth at the end of the year, it won't be recession worthy, if you know what I mean. So keep an eye out on these numbers that we've been talking about, and we will keep watch on them as well. So if there are any other questions, please feel free to ask them. We've got another minute or so, and always like to answer any questions people have. And Daphne, anything else on your end?
Yeah, I'm not seeing any questions. I do want to just thank again our sponsors who are making everything that we're doing at the Institute possible. If you would like to join this growing family, and we would love to have you, so please reach out and let us know that. And then I think on the next slide, Joe, we've got the QR code for the study. This will get you to our economic studies as well as the Q1 report that Joe just highlighted throughout the session today. So take a quick shot of that and you'll be able to get to those reports.
I confirm that it works, Daphne. I used it myself this morning.
Very good, very good.
And thank you to Terry Gaylor, who always helps me out with these presentations and providing information and support. She obviously kicked off the hour with us, but I just want to give a good shout out to her.
Thanks, Joe. Appreciate that. All right, good. Well, I think that's a wrap. Thank you all for joining us. We'll look forward to seeing you next month on our next Future of Engineering Roundtable. Have a wonderful day and be safe.
Bye, everybody.